Hey, thanks for tuning in to another episode of InvestU. Today we're going to be doing an in-depth analysis in the McDonald's stock. So many of us know McDonald's as basically a burger chain, and when we think of how they make money, we probably think of selling more burgers and fries and selling more coffees and shakes, but there's much more to it than that. So let's do a bit of a deep dive and go through some basic stock info for McDonald's. So the ticker for McDonald's Corporation is MCD. It's traded on the New York Stock Exchange. This analysis was performed on the 15th of February 2020. McDonald's has a market cap at the moment of $162 billion, and it's currently trading at $217.09 per share. The number of shares outstanding are 753 million. Let's get into the key metrics. So the price for McDonald's, as mentioned, was $217.09. That translates into a PE ratio of 27.56. An earnings per share of 7.88, which translates to roughly 4% per year. It has a very consistent dividend payout of about 2.16%, and that's the current dividend yield based on the price. And the price to book is not available when you do the lookup on something like Yahoo Finance, so we'll dig into why that might be. The debt to equity is slightly high at 3.82, but there's a lot of real estate that McDonald's has, so we'll get into where some of their debt is and where some of their assets are. The debt to asset is 0.72, which is, again, a bit high. Return on equity is not available, so we will go into that again in depth. The current ratio is 0.843, which is a little bit low. We will want to see something above 1.5 as a value investor. The EV over EBITDA is at 18.69, which also suggests that McDonald's might be slightly overvalued, and there is no gram number. So shifting to the intrinsic value assessment, we're assessing the growth at about 2.97% based on some of the trends that we're seeing. We're going to discount this at 8.1%, and the growth rate in perpetuity is 2%. Using the 2019 free cash flow, we get a intrinsic value of $164.23, which again suggests that the stock is overvalued. So let's dig into some of the trends. From a free cash flow perspective, we're seeing a slight increase year over year. This does fluctuate quite a bit, so there's not a huge uptick that we're seeing in free cash flow over the last 10 years. From an enterprise value perspective, we're actually seeing McDonald's head toward the negative. So we have to head into the annual report to figure out why this may be and what sort of direction they're taking with this. The revenue growth is rather flat or maybe slightly negative for McDonald's year over year. So that is, again, somewhat concerning. We want to see a nice upward revenue trend and a nice upward net income trend. And transitioning to the net income, again, we're starting to see maybe some slight growth there. None of these really are adhering to linear trends when you look at the R-squared value. But they suggest that there's maybe some moderate growth to this. So let's dig into the annual reports and let's figure out where the positives are and where the negatives are. So from a positive perspective, McDonald's is a large franchisor. Over 93% of the restaurants are franchised with a goal of 95%. One of the models that McDonald's likes to follow is that it owns the land and the building, and ultimately the franchisee pays for the equipment, signs, seating, and decor. So when you look at the overall real estate that's on McDonald's books, it is quite large, and their debt is also quite large. So this is where we see some issues from an enterprise value perspective. It is an innovative company that has started to rebrand itself. They have done $3 billion in revenue in delivery services, and that's expanding. You see Uber Eats at McDonald's and a lot of delivery services there now. They're updating their technology in restaurants. We see kiosks, we see apps, we see digital menu boards, which is all tapping into their innovation. So their growth plan is being touted as a velocity growth plan. So they're looking at retaining customers, regaining past customers, and converting customers. Part of this velocity growth plan is focusing in on some accelerators. So they're looking at making the company more digital, focusing on delivery of food, and really gearing the restaurants towards an experience for the future for McDonald's. This is something that's being looked at for a large portion of restaurants in the United States. For some negatives, When you look at the risks in their annual report, you'll notice that they really focus on the intense competitive market. There's coffee shops, grocery stores, many other fast food restaurants, and McDonald's is trying to keep up their market share within this. They do have a rather large market share in the fast food industry, but there are many competitors here that could really take away from some of their revenue. Their debt has increased significantly in the past few years as they've tried to make investments into McDonald's for the future, as mentioned in the previous slide. And their liabilities are exceeding their assets as a result of the debt that they've taken on. So to me, that's a huge risk. Because McDonald's is a large cap stock that has been around for many years, I'm not worried about McDonald's going out of business or filing for bankruptcy as a result of this. I'm more worried about the downside of our investment. And that's one really important thing as a value investor. We want to look for a very positive upside, a stock that's undervalued, and really look for something that's going to protect against your downside risk. So heading back to the intrinsic value assessment, again with a growth rate of 2.97 based on the trends that we've seen, discounting it at 8.1%, looking at a growth rate in perpetuity of 2%, using the 2019 free cash flow dollars and discounting them back, we get an intrinsic value of $164.23, which suggests that McDonald's right now is overvalued. The book value per share is, when you calculate it out using their enterprise value, which is in the negatives, gives you a negative 8.30 right now, which suggests you don't have any margin of safety. So with that, I would stay away from McDonald's at this point in time because it is overvalued and the margin of safety just isn't there with their current corporate setup. Thanks for tuning in to another episode of Invest You. We really appreciate the feedback you guys have been providing, so please keep the comments coming and please click subscribe.